Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back, Broker Daily Uncut. Eva, Costa and Alex here, bringing the year to an end, wrapping up. Mm-hmm. Guys, last time I saw you, Thursday, Christmas party.
Yeah.
Much fun was had.
Much fun was had.
It was a good night or good day tonight, yeah.
Celebrating a big year for Finni.
Yeah. So we had the Finni party and then the momentum party.
Yeah.
Double party.
Double party. They're the best types, at least when it's happening. Not so good the next day.
Not so good the next day. It was all right. Yeah, no, it was good fun, good team, good people there. So
yeah, just on that note, just looking back, I guess over the year from your perspective, what's your takeaways from this year from a broking perspective? It's probably worth having to think about some of your key observations, some of the key changes that we've seen taking place, whether it's changes from APRA, changes from individual lenders. How's the year looking backward?
For me, it was very much, I guess, a revelation that people don't want to be at a transaction. You just do my loan and then see you later. The people want to work long term with somebody. And I've had people that, worked with me from me joining Finni, and actually some people following me from previous places I've worked at. And they want someone to trust to buy their first home, to buy their first investment, to renovate their home, to look at the SMSF. And I've had a lot of clients this year really making me realize, well, actually people want a long-term relationship, and they pass on your details to their neighbors, friends, family, and that's how I feel like it's you can grow your business. It's through trust.
I think an interesting point on that, and again, sort of seeing how brokers interact with their customers is where the service stops and finishes, because you get people that come back to you because they want to refinance for a better rate and they've got a tiny little loan, and it's working out as a broker
to just do that. Yeah,
where it justifies, because I think borrowers don't understand. They just don't understand. You have a great relationship with your borrower, and then they come back to you because they want you to provide a solution, but they don't really understand how you get paid. So drawing a line between doing activities to support borrowers that are going to cost you in terms of time versus leveraging off that, I guess, networking effect, because then they go and tell other people how great you are. That's a pretty challenging thing, I would imagine. Yeah,
it is. But I think a lot of people don't really, I guess, think about that when they first come to us or to me. It's just the relationship we build, and it's like, okay, it's been 6 months. Let's check your interest rate. It's been a year. Let's do evaluation. Or do you want to access equity? Like the constant care, I guess, we want to give them to build from the
service
property.
just doesn't end once the loan's settled.
Yeah.
Especially because we deal with a lot of investors. They want to keep on going again, and they want you to figure out a way on how they can buy another property, be that for SMSF or structuring their affairs in some way that helps them gather more properties. Once settlement happens, it's basically, that's when you actually have the conversation with the client. All right, so what are we going to do for the next one? How are we going to do it? Structure it so then you've got the next 3, 4, 5, 6 months to put that structure into place, which allows them to purchase that second or third property. So, the service doesn't end at settlement.
I think for investors, it's a long-term journey. And the further down the path that I go as an investor, you look at the whole ecosystem, your broker's the most important, and your accountant. There's also, have a relationship with property managers, depending on what location you're buying in. I'm buying in a location and I'm using the same property manager at the moment. You have a relationship with your buyer's agent if you use one. But I was talking to a property manager who I don't actually have a property with them, but I know them quite well. And he said something really interesting. He said that property managers are increasingly coming under pressure from buyer's agents to give a yield that looks good for them to win the customer. So then the PM, and I was thinking of it around the challenges for a property manager, because the property manager gets persuaded to say, yeah, we'll get you a rental of $550. It's not realistic, because the buyer's agent wants to go back to the customer and going, great news, we'll buy it for this. the rent's 550, therefore the yield's going to be something great. They then put it with the property manager. They can't get the yield that they were promised, and they're unhappy with the property manager. But it occurs to me that when that information comes through, you guys get the same information. If you get a yield that's been inflated from one channel or another.
Yeah, that's we do see that.
Yeah.
But the thing is, most banks, not all of them, but some banks, let's say, will do a full valuation of the property. And on the valuation, you've got obviously the value of the property, and you also have an estimated rental.
They do that as well, do they?
Yes, and the bank will take the lowest of the two.
Okay.
But the issue is often as well, banks don't do full valuation. We just have a desktop valuation or AVM, whatever the bank does, and we'll use the rental appraisal, which also the loan then gets approved on income that is not coming. And that could be an issue. But
I guess a couple of things, right? There's getting the loan approved, but there's also, if I believe I'm going to be generating this yield, and I'm running kind of quite close to the wire, and then I find out that I'm 15, 20, 30, 40 bucks a week short of what I expect that's coming in. For a lot of people, that's quite a bit of money, and it has an impact on their standard of living, and a sort of a factor for buyers, particularly first-time buyers, or people who are new to investing, is you kind of don't realize the long-term effect that running on a tight budget has on you. You want the property, then suddenly the reality of, sort of making do with a bit less. And then if interest rates go up, guess what? It all gets tighter still.
Well, not just that, but say there's an issue with the property and you've got to fork out money for a repair.
Yeah.
Say there's some pipes broken. All right, strata, but if you've got a single dwelling and some pipe burst or something, and then you're up for $5,000-$6,000, you're already struggling to, pay that gap that, they said they could get you from the rental. It could all collapse from that. Yeah. And there's some repairs that do cost significant amounts of money, because in the end, you can only do so much research on the property. You don't know what's in the dirt, what's in the ground. This is coming from experience from building a house where, on the surface, you think, oh, yeah, you just need to do X, Y, and Z. But once you start digging, you feel like, you find out this needs to be done, that needs to be done. You're just like, mate, and then it's just a rabbit hole. And then the costs just build, and then it can become just not even worthwhile why you went for it in the first place.
But I guess back to your point, being a trusted advisor, and I see brokers as on a par with accountants, and having that ongoing relationship. When you earn the trust, again, you've got the opportunity to leverage from there moving forwards. Having a quick look, just looking ahead at the year ahead, we've got our targets. You got the goals for Finni moving forward. What's your sort of gazing into the future? What are your thoughts and expectations for 2026?
That's a good question. Well, I hope we can always do better. I think there is a huge opportunity with commercial lending, and that's been already showing in the last few months. SMSF has been huge, and I think investors, regardless how APRA or the banks are going to put, roadblocks, they're going to find a way. There's always a way. 2 years ago, the big magic trust came out, and it's like, do everything in a trust. Now it's being, definitely slowed down. There's going to be other ways to move. So it would be, I guess, an opportunity for brokers to adjust to that and also think outside the box and get it done.
Yeah. What do you reckon, Costa?
I think, like Eva said, I think the commercial space is an untapped market where a lot of commercial deals actually go direct to the bank. And if the broker can start bringing, even 5-6% of that into the broker space, that obviously allows us to write more.
Yeah.
But commercial and the SMSF space is just huge because it's just untapped potential. Yeah.
If my business partner Phil's, I'm going through my first SMSF, but I'm buying residential. Phil's bought commercial, in his SMSF, but commercial. He's evangelical about the benefits of commercial, and I wonder how many brokers playing in the SMSF space already, if they are fully capitalising on opportunities there with their customers. I don't know. From
what I understand, it's still a niche, and a lot of them just don't want to shifting
I
into
find SMSF with commercial, it's a good way for self-employed people to purchase where they want to work from. Whereas they're capped out in their personal name, but it's a good way to buy the business through your SMSF where you've got heaps of funds from like 20 years of collecting it. And that's what I found where majority of commercial loans come from is self-employed people purchasing through their SMSF.
Yeah. We'll take a quick break there, guys. Back in a couple of seconds. Welcome back. Good to have you with us again. Alex, Eva and Costa with you. Unpacking, I guess, what was 2025 and looking ahead to 2026.
Just going back to where you mentioned like what we've seen or what's coming up next year, I realize a lot of people coming to us for top-ups or cash out for renovation of their properties. I think people trying to do numbers of how much is it going to cost me to sell 2% plus moving cost and the time it takes buying another property, paying stamp duty, the time it takes to find they're actually coming to us a lot for, well, I just need 200 grand to fix this or have another room at the back or just making the property better.
I'll tell you something on that note, which is ridiculous. So in every property that I've sold as a principal place of residence, I've only ever improved them when I've sold because the agent comes along and goes, you've got to do this, you've got to do that. And I spend tens and tens and tens and tens of thousands of dollars. And I go, why don't I do this 8 years ago and actually live in the property and it would still have the same value there? So that's an interesting point.
Yeah, I think so. And
so how does that work then in terms of how do you sift through not doing a load of work for a $35,000 top up?
Yeah, obviously there's an opportunity for us as brokers that the client might come just for the top up, but very often they would already have a mortgage that can be made better for sure.
So better rate.
You can move it, you can fix it, put a offset, whatever might be that better the situation. If it's an existing client, well, it's a way also to retain them and service them again.
Back
and they
to
might
what we were
have
saying before, where it doesn't end at settlement.
Yeah, that's right. And then it could be that next time it's equity for an investment property or something else. So there's, I think it's an ongoing service.
You make a very good point though around, excuse me, for owner-occupier, you go, there's a reason why you want to move. Now, some of it may be location and doing a reno isn't going to fix that. But one of my neighbours, their daughter sold in Turramurra and they bought in Turramurra. And, you kind of go, and I know the price bracket that they've been buying at, you're talking well north of $100,000 in stamp duty.
Yeah.
Like if you spend 150 grand renovating your place, and you can do reasonably substantial renovation for that kind of money, or maybe go twice that. A, you save yourself the money on the stamp duty. B, you may be able to add like a significant amount of value to your home.
Yeah, that's right. I think whatever you put in, you'd get back into value. If you add another room or second level, whatever it is that we see happening is huge. Actually, I had a client, a long time client that did a family pledge to buy their first home. 6 years later, come back to me for, it's just too small, it's not working out. We just want to add a second level with a bedroom. We did that. We revalued the property. We got a cash out for, I think we're doing a kitchen. And at the same time, I'm like, there's equity in your property. You've done so well. Why about we look at your first investment property? Just suggesting. And they're like, yeah, sure. Let's do this. So from just doing a 200K cash out for renos, he went to almost $1.5 million in lending for something that maybe why not? Just long term. And that's a client I've had many years.
Yeah, and that's good.
Probably would come back for something else and looking at SMSF, whatever. It's just, there's a lot there, but it's bit by bit. Long-term game.
Your book has grown substantially. So again, looking at businesses, you're probably going to end up with a shifting ratio. When you're starting out and you don't have a loan book, it's all going to be new inquiry, right?
Yeah, that's right.
It's going to be 100%
new
of your customers. There's going to be a transition where that percentage starts to shrink, and then you end up with repeat business or referrals. But then I guess there's also, if you can't keep new business coming in, then you're just making incremental. If people are if they're refinancing or if they're selling one house and buying another, your book isn't really growing
That's right.
to the same pace as adding people in.
Yeah, there's retaining as well. Of course, you don't want people to go somewhere else. So, I guess the growth is slower after a while for sure, unless you put more brokers, new.
This is a challenge, though, isn't it?
Yeah,
right?
it is.
To
There's
actually
new avenues of getting leads.
Yeah.
There's only so much that you can rely on with family and friends. Like once they're maxed out, unless you're trying to get new leads from somewhere else, they're maxed out.
You can't help but think, though, excuse me, as your book grows, the potential for referrals has to increase, but it's a hard thing to do, because I think a lot of brokers rely on organic referrals. And of course, whenever I talk to them, they go, oh, I know if I'm talking to somebody who's talking about buying, I'll go, I will refer them to various professionals that I know are going to help them, a buyer's agent, broker, accountant, whatever. But, there's probably a way, I think, with as the book grows, systematic and process-driven way to actually generate, not, hey, not giving them a nudge and going, oh, let's review your loan. Hey, maybe you ought to be doing this. How much equity have you got? But actually saying, do you know anyone who's looking to buy? Do you know anyone who's looking to, to invest for the first time? We would love to help them. That, I think, is the opportunity to grow the book.
Actively asking for it.
We better do it.
Yeah, no, I would agree with that.
Yeah, it's an active approach that takes time for sure. Yeah.
We'll take another break, I reckon, there, guys. Look, when we come back, this is the last podcast for 2025. Let's just have a, sort of a think about, some of the environmental things that have been going on. Let's look at sort of market share. Let's chat away.
The interest rate on hold.
We've done interest rates to death, but look, we'll just think about sort of how the year is rounded off. Don't go anywhere. Welcome back. Wrapping up the year, guys. What are the key takeaways? What are the key thoughts?
Well, we've got the interest rates situation where this week they did say it's going to be on hold.
Mm-hmm.
The market is predicting now that it will stay on hold pretty much all of next year. I think the only major bank saying that it won't be is Westpac. They still expect 2 rate cuts, one around May and August. I don't know what they see that everyone else doesn't, but they see something. And yeah, so it's going to be an interesting year. If we can get inflation under control, that would be a good thing. So we'll see what inflation does, and that would pretty much determine where rates are going to go. If they're going to stay, go down, or potentially even go up. You
kind of get the feeling that certain markets are going to move regardless of what happens with rates. Yeah. You sort of everyone's talking about Melbourne still. There's been some reasonable growth in Sydney. So you sort of get the impression, I think, we're looking at there's a high percentage of investors out there once again. So I think that they're going to keep looking for.
Well, right, we're still undersupplied, regardless of what interest rates do. There's still an undersupply of properties.
There's a horrible undersupply, yeah.
So regardless if they go up once or down, people need places to live.
Yeah.
And if there's obviously supply and demand, the demand is outstripping the supply, everything's going to go up.
Yeah.
It's just, economics 101. So I don't see house prices, regardless of what interest rates do, are going to change.
I guess also looking back, so the tail end of this year, you got APRA has tightened in terms of investor lending. Do you think that's going to impact investor appetite moving forward?
No, look, I think what they announced freaked everyone out, but it's not much there. It would take a while to get to 20% of one bank's book to reach that. So what everyone thought, oh my God, that's they put the brake on. It's more like, okay, just sit tight, put your seatbelt on. We'll see what happens. But it's that's not going to affect much. I think the big thing for investors is banks really tightening their lending on trust lending. That is an issue.
It is an issue because you've got so many people already in that trust structure, and then that's going to limit them.
Yeah, it's going to limit them. That's going to get them stuck to where they are. They're going to struggle to refinance. They might never be able to get the equity out of that property in that trust. So that is an issue. We'll see how we go with that. But probably the second and third tier lender will compensate for what's happening. I would expect. Yeah.
Broker market share seems to be holding steady. 3 out of 4 borrowers are now using a mortgage broker, according to Cotality, 77.3%. That is down slightly, 0.03, but nothing major. I can only see that going up slightly, but yeah, everyone still wants a mortgage broker. They can provide you with more competition, more interest rates. Do people even go to banks for a loan anymore? Like walking.
They do with CBA because they're closing the door on us to do the.
No, I just like there's so many banks out there offering so many different rates. I don't understand why you would actually just go.
But borrowing's just changed. Over the last 20 years, you've seen significant reduction in retail branches. I can remember going back to, I don't know, sort of 2006, 2007, there was a massive drive from Bank West opening up. Yeah. Branches all over the place. They called them, I think they called them stores. It was a big drive. You've got most people now don't want to walk into a branch. And even if you do want to walk in a branch, they're not there anyway.
Yeah.
So you've got to shift in terms of how banks are interacting with their customers. You're going to have increasing drive from lenders to want to connect directly and to speed up the process and to sift through and work out exactly what those borrowers look like. At the moment, they look so vanilla that there's barely any of them around, really, to have that sort of,
yeah, right.
The speed of process to go direct means that I guess the sort of the risk you're taking would have to be so minimal not to need to go and check with the broker and make sure, and the banks, you're talking about sort of very vanilla loans.
Yeah, there's definitely some of that where clients go to a bank and they're like, oh, this person just had no idea what I was asking, or, had to fight for months before they said that it wasn't going to happen. Or there's definitely some of that where the home lending specialists or whatever they call there, just don't have experience with
they've
complex
only got experience in that bank.
Yeah,
and
as well.
They're only going to really they're basically salespeople in the end as well.
But they're always going to want proprietary channels. That's never changed from lenders, primarily banks, and it's okay for them to have that. They've had proprietary channels through high street lending, and they're always going to want to have a volume that goes through those proprietary channels. As long as I think it's okay to have a multi-channel strategy. The areas where you start to get conflict is if you're offering one product via one channel and not via another. And then, even that, if you make your proposition unattractive to brokers, then they stop recommending your product. So you're going to get this ebb and flow, I think, of how you get particular products and whether it's through the proprietary channel and whether it's through the third-party channel. If one lender tightens up, there's always another looking to step in, because with high 70s of all volumes going through the broker channel, you can't ignore it. We've covered it before in previous podcasts, but I thought the Agile session that we went to, looking at the shift now of fewer potential customers per broker, means that brokers compete increasingly with brokers, and that is going to be the future of the industry moving forward.
Yeah,
I think it's from what I read, it's the advice is pick a niche and be excellent at it.
Yeah,
instead of trying to do everything sort of okay. That's and I think I see that happening on social media.
I think you pick your niche as a primary.
Yeah.
But, and if you pick a difficult niche, let's say you're an SMSF specialist or you're an investment specialist, guess what? The vanilla stuff is kind of pretty easy. If you're a specialist in vanilla.
They come with it anyway. People would do an SMSF, would refinance their home, whatever.
Yeah.
Yeah. But I see that on social media. It's like, oh, I'm the broker of, I don't know, first home buyer. I'm the broker of
expat lending
lending or whatever it is. Yeah.
Yeah.
I think that's the trend.
Yeah, no, I agree with that. You can't be the best at everything.
Everything for everyone.
Just not possible.
Phil Tarrant can. So he tells me.
Shout out to Phil Tarrant.
Look, no, it's absolutely right. Guys, it's been great. Costa, having you on for several episodes now.
Thank you for inviting me. Yeah,
very much part of the team.
I'm really enjoying it, and hope everyone else is.
Yeah, good. I'll lean very heavily on you. Thank you very much for your contributions.
Thank you. Thanks for having us.
Gives a lot more value to this podcast. For everyone else tuning in, look, we loved having you with us. Thanks for the feedback. Have a fantastic break. And look, we look forward to catching up with you in the new year. Let's hope it's a big year. Thank you.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.